What's up guys, welcome back to the channel. Today we're going over what options are and how to trade options as a beginner. Whether you've never traded options or you've just kind of dabbled with them before. This video will show you all the basics and everything you know to get started with trading options, especially for beginners. So the first thing when you want to trade options is you need to get approved for options. So you need to go up to your account and then settings and then look for options trading and enable it. It's based on risk tolerance and how much trading history you have. So I believe everybody gets approved for level 2 trading, which is just default options trading. You can apply for level 3, which offers spreads. Those are for another video, but basic options trading is just level 2, and that allows you to buy and sell puts and calls, which is what we're going to go over today. So once you're approved for options, you need to go and find a stock that you're willing to buy. So I've chosen Apple here because if you look at their 1-year chart, you can see that they definitely have an upwards trend. You can't really count this drop because the entire market dropped here because of the pandemic. But besides that, Apple's been on an upward trend pretty much since it's been started, as you can see in this 5-year chart. So with looking at Apple, this kind of leads me into my first tip, which is not to buy options for companies you don't believe in or companies that are kind of just hyped because of videos or social media or the news. You need to actually have hope in this company that you choose, because if you choose a company that's just going down, I mean, you could buy puts, which we'll go over soon, but you don't know how the company is going to react. You don't know what's going to happen. So anyways, let's jump into options here with Apple. You click this trade options button here, and it's the same on mobile. You just click trade options. So after you click trade options, you'll be brought to a screen that looks a lot like this. And it can seem quite intimidating at first, but I can assure you that it's not, especially once you've practiced and you kind of know what you're doing. But the basics are calls and puts, and you can buy or sell them. Today we're only going to go over what buying them is like. But in a nutshell, buying a call, you want the price to go up, and buying a put, you want the price to go down. So for example, say you bought this call at a strike price of $3.90. The strike price is basically the price you want the stock to get to or higher to start making a profit at expiration, which is the day up here that you choose. You can choose many days. You can choose way out in the future, but the farther out you choose, the more expensive it's going to cost. And the cost is the premium on the right side here. The premium is the price of the contract that you're buying from a seller. Everything in options is between a buyer and a seller, so there's somebody on the other end, and you're the one, when you're buying them, you're the one paying for the contract. This contract essentially gives you different options depending on what you choose. So in our example, if the price is currently at $3.84, and we chose this strike price of $3.90 at a premium of $7.13, everything in options is times 100. So this $7.13 would cost $713. So with calls, how I said that you want the price to go up, that's because if this price of $3.84 went past $3.90, say it got to $3.95, you would have the ability to buy 100 shares at $3.90, even though the price went up to $3.95. So you can see how you can make a lot of money if you choose the right strike price and the right date for something to happen. So if you chose $3.90 and the price went up to $3.95, you would make the difference between these two times 100. So this is $3.95 and this is $3.90. So you'd make that $5 difference times 100. So you'd make $500. But now let's go over puts. So puts are the opposite of calls. You essentially want the price to go down. So if the price currently was at $3.84 and you bought this premium here at $3.75, if the price dropped below $3.75, say to $3.70, you would have the right to sell 100 shares at this strike price. So it seems kind of counterintuitive because you never really had the shares anyways, but that's kind of what the contract is between options. You have the right to sell 100 shares. So that's why when you're buying puts, you want the price to go down, because say the price went from $3.84 and it dropped all the way to $3.70, but you bought this put at $3.75. Well, you would be able to sell 100 shares at $3.75, even though the price is at $3.70. So you would make that difference again, just like the calls. And so you would make that $500 difference because everything is times 100, but you're also paying for this premium again, just like with calls, everything's times 100. So you'd pay $455 for this share, and that gives you the right to sell 100 shares at $3.75, no matter how far the price drops. But now you're probably wondering what happens if the price doesn't drop. Well, if you bought this premium at $455 and say the price just stayed here, it didn't move, say it stayed at $384, well, you would have paid $455 and it would now be worth $0. Because if you think about it, why would your brokerage let you sell 100 shares at a loss? Does that make sense? So if you wanted to exercise this option, it would be pointless because you would be selling 100 shares at $3.75 and the current price is at $3.84. So you would lose that $9 difference between them times 100. So you would lose $900. So your brokerage isn't going to let you do that because that would be foolish. So you only lose your premium that you originally paid for. So in this case, it would be $455 if the price never dropped below $3.75. If it drops below $3.75, say it goes all the way down to $3.60, well, then you're profiting the difference because you can sell 100 shares at $3.75. So in that case, you'd make $15 times 100, so you'd make $1,500. So there's another thing in options that determines the price of the premium, and that's called in the money and out of the money. And that's essentially when the share price surpasses your strike price that you chose. So if you were buying calls again, we want the price to go up. Say you bought this $3.90 strike price and the price goes from $3.84 up to $3.95. Well, you can see that this $3.90 would now be two below where the price is currently at. So it would be just like down here, how this is two below. And you can see this is worth $12, where this was originally worth $7 for the premium. And so if you bought a call and you didn't want to hold it all the way to the expiration date, you can go ahead and sell it for a profit if the share price went above your strike price. So if this $3.90 went from $7 and now say it's worth $12, you can sell it for $12 times 100, so $1,238, but you bought it for $713, so you would profit that difference. So you'd make $525, and that could happen in a day, in 2 days. That could happen within a couple hours that the stock price jumps up. So you can see how you can make a lot of money, but you can also lose a lot of money, because if you bought this $3.90 and the price never got up past $3.90, you would essentially lose this $700. And you could sell it before it expires because it also becomes less and less for the premium as time moves on. And that's called theta, which is when you click on these, you can click on an option and you can see the Greeks down here. There's delta and theta, which are the two main things people pay attention to. So delta is essentially how much you will make per dollar that the stock price goes up. So you can see here, you would make 44 cents, which is times 100, as everything is in options. So if the price that's currently at $3.84 went up, say, to $3.85, so your premium price would go up $44. It would go from $713 up to $757, if I'm doing that math right. So after the stock price went up $1, you just made $44, and you can go ahead and sell, and you secured $44. But you can see if you hold them longer, you can also make more money because the stock price could go up more. So if this went up $20, say in one day, which most likely would not happen, but if it did, this would be times 20. So you would make $880, and this would now be worth $15 and something cents. So if you sold it at 15 and you bought it at 7, you're making that difference times 100. So you'd make about $800 or more. But you also have to keep in mind theta, which is how much the premium loses each day. So in this case, it would lose $55 every day. So it's worth $713 when you buy it. Tomorrow it'll be worth like $670 or whatever. And then the next day it'll be worth $620 and so on until it gets to expiration. And this theta increases, it's exponential. It gets bigger as it gets closer to expiration. So a lot of times people will say to buy it with an expiration date that's pretty far out, because then you don't have to worry about theta and time decay. So if we were to buy instead of next Friday, which is in 8 days, we could buy over a month out. And then you can see that now the premium costs a lot more, but that's giving you the ability to let the price move and the stock can fluctuate a lot more. So if we go back to this July 24th, you can see this $3.90 is worth $713. Now if we go to August 21st, that $3.90 is worth $17.70. And then if you check out the theta, here it's only $27 a day, where before it was $44, I believe. And the theta becomes less and less the farther out the money you go. And out the money for calls is prices that are higher than the current share price. And for puts, out the money is prices that are lower. In the money is where the premium is a lot more, and the price, it's already past that. So with a put, the share price has already dropped, and it's almost like the current stock price has absorbed each new price as it drops. So with puts, you want the price to go down. So 384, if this dropped down to 370, this one and this one, the 380 and the 375 would now be in the money, and their premium price would be higher. So you would be able to sell them. So say this one went from $14.95 and now the stock price dropped to $370. This $14.95 might be worth $19, And because you bought it for $14.95, you could sell it for $19.55 and profit that $500 difference. So say, for example, if you bought this 370 strike at $12.98 and it's expiring August 21st, which is about a month out, if the stock price doesn't drop below this or get closer, if it goes up or stays the same, this premium is going to become less and less. So it's going to get smaller and smaller as it gets closer to the expiration date. And going back to calls, in the money is everything it's absorbed again, but with calls you want the price to go up. So you can see how it's currently at 384. If it went up to 390, this 385 would now be in the money. So all these are in the money, all these below the share price. And you can tell because they cost more for the premium. So generally when you're buying calls and puts, you don't want to go more than about 8 strike prices out of the money. So for example, like this would be 1, 2, 3, 4, 5, 6, 7, 8. You wouldn't want to really go past 420.
It's 420, man.
Because the farther out the money you go, the less likely it is that the stock will actually hit that strike price, or that the stock price will fluctuate enough to where you can make money on the premium. Generally, that doesn't happen. So you can see up here, the farther you go out the money, this $500 strike price costs only $120, and this $495 is only $128. So if the price moved by $5, you would only get $8 of profit. Where if it moved by $5 down here, you'd be making $300 profit. That is, if you were to sell after you had bought it at this price and you sold it at this price. So you don't want to go too far out the money. You want to generally stay within 5 to 10 or so. Usually 7 or 8 should be the max, but if you're finding a good deal, it doesn't hurt to go a little farther, but that's kind of a general rule of thumb. A lot of people kind of wonder, well, why not just buy really far in the money then and kind of guarantee a profit? Well, that's not such a terrible idea, but it comes with a cost. So if you're buying a call and you want the price to go up, price is currently at $384. If you bought way in the money, say at $280, like obviously Apple's not going to drop $100 in the next month. And if they did, something major happened, but you're going to be paying a lot more for this premium. So you're paying $107, which is times 100. So you're paying $10,700 for this premium at $280. But you can also lose money on this trade too, because as this gets closer to expiration, this is going to be losing money, but it will never lose more than the difference between the strike price and the share price. So in this situation, from 280 to 384 is $104, and that times 100 is $10,400, and you paid $10,700. So the most you would lose is about $300, because remember, with a call, you have the right to buy 100 shares at 280. And then if the price just stayed at 384, you can just sell them back at 384. And then you profit that difference, but it's not really profit because you had to pay for the premium. But not everybody has the funds to be paying for plays like this. Not everybody has $10,000 they can just throw at a play at a call for Apple. A lot of people who are trading options are trading with smaller accounts, less than $2,000, and they don't have $10,000 to throw at this option. Especially if they were to lose that money. Say Apple did drop below there. Say Apple dropped from 380 down to 270 or something. Well, this might only be worth a couple dollars now, and say maybe you'd lose $9,000 or something. Most people don't have that kind of money laying around just to throw at 1 or 2 plays. But there is a way to combat this, and that's through spreads, which we'll go over in another video. With spreads, you're essentially limiting the potential profit, but you're also limiting the amount that you can lose. You know how much you can profit and how much you can lose going into it. But that's for a whole nother video. But other than that, I think this kind of wraps up everything, kind of gives you the basics of how options work. We'll also go over selling options in another video, because as you can see, the prices stay the same when you buy and sell, because there's a buyer on one end and the seller on the other, because it is a contract for 100 shares. Like I mentioned, we'll go over selling in another video, and we'll go over spreads. So I think that about wraps everything up. If you have any questions, or if you don't understand something, go ahead and leave me a comment and I'll get back to you, and I'll do my best to answer your questions. Also, if you guys want a more in-depth video, I can go more into depth with like the Greeks, how exactly delta and theta and vega and all these change as the stock price goes up and as expiration gets closer. I can also go over the bid and the ask, which is something to keep in mind when you're buying options. That's not really very advanced stuff, but it's something to keep in mind. If you're just learning options, I think this video should have kind of covered the basics. I mean, obviously there's more to learn, but just keep in mind when you're trading options, you shouldn't risk more than you're willing to lose. Like when we're selling calls and puts, we know how much we can lose based on the price of the premium. Whatever you pay for the premium, that's how much you can lose, but you can make pretty much infinite. You can make however high the stock price or low the price goes, depending on a call or a put. And like I mentioned, if you have any questions or comments, leave them down below and I'll get back to you. But with that said, if you enjoyed this video, make sure you leave a like and let me know if you want to see more in-depth options trading. I can even give examples and do live trading if that's something that'd be interesting to you guys. Just let me know down in the comments. And make sure you subscribe and hit the notification bell so you don't miss when I upload videos like that. And also, if you guys haven't signed up for Robinhood or Webull, you can use my links down in the description and you'll be getting 2 free stocks from Webull. One when you create an account and one when you deposit $100. And those are worth up to $1,400. And when you create an account with Robinhood, you don't even have to deposit anything, but that stock is worth potentially up to $250. So that's a pretty good deal, just signing up for the brokerage and you get a free stock to start off with. But with all that said, thank you so much for watching, and I'll see you back here in the next one. Bye.